Okay, it's recording now. Okay, so first of all, how do you learn this subject, right? The most important thing is that you always have to learn the concept. So what do I mean by the concept? You will hear me saying certain words that will be new to you, and you might be confused, right? It's because you don't have background of those words. What do they mean? So it's very important that you learn those key terms, those concepts, so that even when you read a question, when a question comes and say calculate standard deviation, in your mind you know what standard deviation is. Now, if you skip that part, usually people will skip that part. They will find something very similar to the question in the textbook, and then they will just follow the steps, right? That is a very, very dangerous way of learning, because an exam will come and then it will use a different term. There's many terms for one meaning, right? You'll find that there's expected return, there is cost of capital. They have the same meaning, right? But you can hear it's expected return and then cost of capital, right? So it's very important that we learn these keywords, so that even when a question comes, we are able to understand and then we are able to answer confidently. All right. So like I said, the focus here will be on expected return and standard deviation, right? So this is very, very, very limited in a way. But I'll just explain what expected return and standard deviation are in short. So I won't be going in detail, okay? So imagine you see a company or you see a share and you want to invest or you want to buy it, right? The main reason of you investing or buying is so that you can get something in return. All right. So that means you have an expectation towards that investment or that share. You expect something, you expect a return. All right. So that thing that you expect is what we call expected return. Of course, if we were to use a textbook, we would use those big words, right? And that's for you to go and memorize them. But for me, my job is to make you understand these things. So the expected return is what you expect when you go and buy a Pick and Pay share or a ShopRite share or FNB share, right? You look for expected return. When you save your money, you look for expected return. All right. So with the information that we have here, we will be able to calculate that expected return. And that's what you do even in real life. These things can be applied in real life. And then standard deviation. We all know that when you go into business, there are two main things that we focus on. And that is the return and the risk. And usually the risk is what makes us run away, right? I'll say, no, this is too much. I can't take that risk. Or you will hear a Ponzi scheme or maybe an advert that says, come join my classes, guaranteed pass, meaning there's no risk. Right? Then you'll be like, nah, this is the tutor I want for myself because there's no risk. I will pass. But there's no such thing in real life. Even in financial management, you'll see in the textbook, we have what we call risk-free rate investment, but there's no such thing in life. It can be said that it is a risk-free rate, but there's no such thing in life. All right. So how do we measure risk? We measure risk by using a statistical tool called standard deviation. There are many other tools, but in your syllabus, you'll be using standard deviation. Right. There is also, is it coefficient of variation? Yeah, I think so. And I don't remember the other one, but yeah, standard deviation is the main one that you will see often. Okay, let me try to highlight what I'm speaking on. So this is the word I'm referring to, right? The standard deviation. So when you want to measure risk, that is the standard deviation. Okay, so a question can come and say, what is the risk of this asset? What they are saying to you is calculate the standard deviation. Or a question can come and say calculate standard deviation of two shares and then do comparisons and then give your opinion. Now, if you don't know what standard deviation mean, how can you even give an opinion on this? So you see, it takes you back to what I was saying, that you must understand these words so that you are able to answer these questions confidently. All right, so we know what expected return is, and then we know what standard deviation is. So it should be easier for us to understand this question and be able to answer it. Now, something I should warn you guys about is that this subject is totally new to some of you, so you should be patient with yourself. Some of these things might sound difficult or confusing. Just be patient with yourself, give yourself time. Usually you can start panicking if you watch the video 3 times or 4 times, you still don't understand, or you attended the lesson many times, still don't understand. That's when you can panic. But for the first time, you really have to just take things as they come. So the question says, Afrika Academics decided to conduct in-depth research and analysis of establishing a website for their online lessons and courses. Now, the in-depth research and analysis have proved to be revealing and insightful, producing the following information in terms of risk and return of running a website. So there's this small company here, or small firm or small business called Afrika Academics, right? They want to establish a website, so they want to invest in a website. So from their research and doing some analysis, they came up with information. This information is in terms of risk and return, right? So we're not talking about marketing, we're not talking about other things. We're just focusing on the risk and return of running a website. So they discover that the website will cost 35 million rands. I know it's a big number, but yes, that's what it will cost. It will cost 35 million rands. And then Mr. Ludoba, who happens to be part of the owners, requires 12% on his investment. All right. So what you require is what you want. Does not mean is what you will get. That's what you want. Okay. So Mr. Ludoba requires 12% on his investment. So remember, Mr. Ludoba and Afrika Academics are 2 different entities or 2 different people. The company is on its own, the owner is on his own. So Afrika Academics management's risk preference is risk averse. So now this takes us back to what I was saying about these words being new and then being confusing. So risk preference, this refers to the management preferring a certain type of risk or a certain level of risk. So you can have management that likes risk. All right, I can just simplify it for you and just simply say they love risk. Right? Some people, they love taking risk. And then you can have a certain management that does not like risk. Right? Let me say it does not. Sorry about my handwriting. Does not like risk. Right? So in finance, we'll say risk averse. Then you'll have some which are risk neutral. They're just in between. Okay. So risk preference is very important to know because when we find the results, we will know if this investment we are taking it or not. Sometimes investment can be profitable, but the risk is just not good enough. Example, you look at trading forex or you look at trading stocks, right? The return is very, very, very nice because some people are scamming, they're posting big cars and all of those things, but the return is very, very nice. However, the risk is just too much, right? So now it will depend on what kind of risk preference do you have as an investor. Do you love risk or you do not love risk? If you don't love it or you don't like it, then definitely trading forex is not for you, right? So the management of Afrika Academics does not like risk much, so they're very risk averse management. So the management is willing to accept nothing more than 6% in terms of risk. If the risk is more than 6% when they invest in a website, then definitely investing in a website is not going to work for them. All right. So below is information that we will be using to calculate the risk and return. So we have scenarios here. Usually these scenarios, they are just describing the conditions of the economy, right? When things are pessimistic, we can imagine they are worst. They're at their worst, right? You can write here worst. Let me try to change the color. And then most likely is what we expect. And then optimistic is the best outcome possible. Okay, so these are just descriptions. The most important thing will be the numbers. So what we have next is the probability. What do we do with the probability? The probability is just telling us what are the chances of those conditions happening. What are the chances of things turning out the worst? It is 30% chance that things will turn out the worst. All right, and then what are the chances that things will turn out the way we expect? There's 50% chance. And then what are the chances that things will turn out the way we don't expect but the best? And that is 20% chance. Usually the best outcome, there's always less. It's like when most people come to me and say, hey, I want to join your lesson for FMA500, and then they end the statement with, I also want a distinction. I will say, we will see. All right, because I know the numbers. But I'm not saying it's not possible. Last semester it did happen. The other semester it did happen, but I think it was 2 people each. But FMA 101, that's where you will get a bunch of distinctions. So those are the probabilities, right? So we then have 2 options. Obviously, when you want to invest, you always want to have 2 options, or you always want to have more than 1 option, right? So that you can compare. You can just go into the market and then say, I'll choose this one. You must have options. In this case, we have 2 options. There's website A, there's website B. All right. So if we invest in website A and then things turn out the worst, we will make 10% on our investment. If we invest in website A and things turn out the way we expect, we will make 14%. If things turn out the best, we will make 18%. So you can see as things turn out the best, even the return increases. Going to website B, if things turn out the worst, there is 9%. So definitely website B already is performing worse than website A. And then if things turn out the way we expect, there will be 12%. And then finally there will be 15% if things turn out the best. All right, so you cannot just conclude by looking at this to say website B will be the best or website A is definitely the best. You really have to calculate. You will be shocked by finance that when you look at things, they just look easy, straightforward, but when you do calculations, they come out the way you did not expect. All right, so before we start the calculation, did we understand the information? If you did not understand, you can ask, and then I'll try to repeat something. If you did understand, you can just be silent, then I'll take that as yes, I do understand. Any question? Okay, that is perfect. All right, so the first question says, calculate expected return and standard deviation for website A. All right, so we're going to need to draw a table. So first one is website A. So we will have to draw a table for that. About 3 columns. I don't know how many rows. Like that. Okay. So in the first column, we will have probability. All right. We'll have probability. In the next column, you will have a return, and then finally we will have the expected return. Because remember, the question said first thing that you must calculate is the expected return. If you can't see the colors, you'll just let me know, guys. Okay, so under the probability, you'll go under website A, and then you'll take the probability first. The probability is 30%, 50%, and 20%. So it's 352, right? So you'll have the 30%, you'll have the 50%, and then you'll have the 20%. Okay, and then we look at the returns of website A. We have 10%, 14%, and then 18%. Okay, so you just go and you write them down. So you can see already that the module is easy, right? Just like that. So now the calculation starts. Now I hope that you are using a casual calculator, the pink one or the blue one. I hope. If you're not using it, still fine. And let's just hope you know how to use that calculator, because the challenge most students face is how to use a calculator, right? Because you will be converting numbers. Sometimes you'll be converting even bigger numbers. You'll be converting from decimals to percentages. You'll also have to round off. So knowing how to use a calculator is very important, because you could think you're doing the right thing, but the way you're pressing the calculator is just not the right way. All right. So how do we get the expected return? Very easy. You will multiply your probability with the return. So that's what we are going to do throughout. So this is more like a routine question. Once you understand the first step, you will understand the next two steps. That's how easy it is. But like I said, sometimes knowing how to use the calculator could be the difference. And also the confidence, having confidence is very, very important. This is what I will be preaching throughout, right? You will see throughout the semester what I mean by that. So the probability, the first one is 30% times the return, which is 10%, right? And that gives me 0.03. So this number must be expressed in percentage, so we will convert into a percentage by multiplying by 100. When we multiply by 100, we get 3%. All right. So if you did not understand that, I'll just use the next example. So you will say 50% times 14%. Okay, so initially you will get 0.07, and then you convert that into a percentage, you will get 7%. So should I show how to press the calculator on the screen, or are you all fine? Do we all know how to use a calculator? If there is one person, you can simply say, please do show. Then I'll show the calculator on the screen. Okay, someone raised their hands. Yes, you can speak.
Can you please show us?
Okay.
Thank you.
No problem. You're welcome. Okay, so just keep the numbers in your head or just write them down somewhere so that when I press on the calculator, you are able to follow. You can just take the recent one, the 50% times 14%. But I think it will be easy to keep in your mind. So we will do that, the second one, 50% times 14%. So I am using a casual calculator, right? So this will apply to casual calculator users. If you're using another one, then definitely you might have to do things manually. So remember we said 50%, okay? So I'll have the 50 shift, and then there is a percentage sign there. So you can see we have 50%, okay? Then you'll say times 14, which is 14, shift, and the percentage sign there. Then you'll press your equal sign. You see you'll get 7/100, or if you press the SD, you will get 0.07, which is what I said you'll get initially. Okay, and then you don't do anything to that number. You just multiply by 100, and then you will get that 7, right? So let me just repeat. So you'll have 50% times 14% equal sign, multiply by 100 immediately to convert, and then you'll get 7%. Is it clear now?
It's clear. Thank you.
You're welcome. Okay, so this is the benefits of using a Casio. From what I know, is that what you write with your pen is what you will type on your calculator, right? So you won't have to do anything manual. It's like automatic car. That's why I like it for students, obviously. Okay, so now we go back to our answer sheet. So we will do the last one, right? I will have 20% times 18%. I'm not going to write this one down because we all understand by now. So 3.6%. So after you calculate those three amounts or those three values, which are this one's over here, you will add them together. So when you add them together, you will get expected return, right? So I'll just write here. Expected return, we have 3% plus 7% plus 3.6%, right? That will give us 13.6%. That is our expected return. All right, so you can see this is very easy, right? Very, very, very easy. But I promise you, the way your lecturer will structure these questions, you will hate him. He might even do these calculations for you and just come up with some funny question. So yeah, those things, they happen. So which is why you have to be very, very humble and be dedicated so that you can be ready for any possible thing. So we now do we have any question about this before we move to standard deviation? All right, perfect. So we now move to standard deviation, right? So the standard deviation, there's many ways of calculating it. I'll just start with the simple one because this module is very new to you guys, but one day I'll teach you another method. So for now, I'll just start with the simple one. All right, so once again, we will have to draw a table. Okay, so you must write the standard deviation. So this one is the one which most of the time people struggle with, especially since it's the first time. All right. So the first column, we will have probability again. The next column will have return again, and then in here we will have return minus expected return to the power 2 times p, which is the probability. I'll just write p here, and then I'll write rj here. So this ER, the expected return, remember, is the one we just calculated right now, 13.6. Another thing about finance is that the next question might require that you have the solution from the previous. So there's no way you can run away. You really have to understand the steps. Okay, so our probability, remember, it is 30, 50, 20. Right here they are, in case you're wondering. 30, 50, 20. Okay, so come here, you'll have 30%, you'll have 20%, no, 50, not 20, and then here you'll have 20%. Right, remember, we're still calculating for website A. Let me just indicate here. Alright, but now we're calculating standard deviation, which is the risk. So we'll take the returns of website A, which is 10%, 14%, and then 18%. Okay, so you'll have the 10%, 14%, and then 18%. So how do we calculate these values for this column? So what you see here in this box, something like a formula. It is directing us as to how do we calculate this. Alright, and I will show that on a calculator. This one I won't even ask, because I know can be challenging. This one I'll definitely show. But first I'm going to write it down so you can understand. So I will try to enlarge it. Right, we have a bracket, we have this RJ, which is a return, minus ER, which is expected return, to the power 2 times P, which is probability. So that RJ is our return. Alright, so our return is 10%. So I'll write 10% over there. Minus expected return. Remember, it's the one we calculated just now. 13.6%. This one over here. You will write over there 13.6%. Close the bracket, to the power 2 times P. What is the P? 30%. Just like that. Do you understand the substitution, or should I repeat again?
Can you please repeat?
Okay. So this here is a formula that will direct you, right, as to what do you put, what do you use, and so on. So you're going to open the bracket, and then you have RJ here. So if you look at this RJ, it can be any letter in place of J. It can be RP or whatever, right? So if you look at RJ and then you look at the information you have, where do we find those returns? It's this column here. This one, right? And the focus right now is on this row. Right? We do row by row. So where how much is the RJ in that row is going to be 10%, right? So you're going to substitute your 10% over here. Then you say minus, and then we have this ER over here. This ER stands for what? Expected return. Right, so what is the expected return of website A? It is the one we just calculated over here, and that is 13.6%. Okay, so you will substitute that 13.6% like that. Then you close the bracket, to the power 2 times P. What is our P? 30%. All right, like that. So you're going to punch this into your calculator. If you're using a casual, it will look exactly like how we wrote it. If you're using other calculators, then you might have to, yes, you might have to do many things to get to the final answer. So the answer that you will get here initially will look like this. Okay, so please let's not panic. This is no different from what we did previously, just that the number is a bit longer. So when you get this number, it's in a decimal form, right? You must write it in percentage. What do? You multiply by 100, okay, to convert into a percentage. You multiply by 100, so you'll say times 100, and then you will get 0,038888. Okay, so obviously you can't write this long number. So what do you do then in this case? You will round off. When you round it off, you will get 0,04%. Right, the rounding off issue. If you struggle with some mathematics, this is something that you'll just take care of throughout the semester. That is possible also, right? But that number we just rounded off, right? But let me explain rounding off in short. I'll just be short, right? I won't go into detail by rounding off. Hopefully it makes sense. So imagine someone owes you money. I will ask this question, and please guys do answer. If you don't answer, I'll just assume you guys know rounding off. So let's say someone owes you money, and then this person owes you, let's say, 1,098, right? This person owes you 1,098. So will you prefer that this person brings to you 1,100 or bring to you 1,090? So please, you can all take turns if you want, and then answer this question. So I repeat, right? Someone owes you money. They owe you 1,098. Will you prefer that this person brings to you 1,100 or bring to you 1,090?
1,100.
Okay, so we have the first person saying 1,100. Anyone? You can speak, guys. You don't have to wait for me to say your turn. So we have the first person saying 1,100. Any person with a different answer? Okay, so it's only one person. All right, so, well, I will agree with the person that says 1,100, and that's because the difference is just 2, right? It's just 2 rents. If you add 2 rents there, then it becomes, so this 2 rents is really not that much of a big deal, right? As compared to if they pay 8. If they pay 8, it means they reduce the amount by 8. That's a lot. All right, so the idea behind rounding off is just that we have to take the amount to be a whole number but closer, right? You can see that this is whole number, right? You won't even have coins when it comes. Just be 200s and 100 rands, but this one will have coins here, right? And people don't like coins, so I hope that idea does make sense, and I'll assume that it does make sense because only one person did answer. So that's the idea behind rounding off. So even in this case, if you look at this number 0,03888, if you do round it off to 2 decimal places, the closest it will be 0,04. That's the closest, right? So that's why we have 0.04%. So now I will calculate the second one without this long explanation. Hopefully it will simplify it even more this time. So our return in this case is going to be 14%. So you'll write over there 14% minus our expected return does not change. It's the one we calculated. You'll see there in yellow, that's 13.6%. That is our expected return. And then our probability this time around will be 50%. Okay, so this one I will show it on a calculator like I promised. Okay, so what you will start by is opening the bracket. Remember, like I said, KU, the best thing about it is that what you write down on your paper is what will appear on the calculator. If it does not look the same, you did something wrong. So you'll open a bracket, then you will enter the return, which is 14%, and then you will minus the expected return, which is 13.6%, and then you will close the brackets, and then you will put in there to the power 2 over there. So we have to the power 2 over there, and then we multiply by the probability, which is 50%. So you can see this looks exactly like what we wrote down. So you'll just press equal sign. You see that this funny number there. Don't mind this. Sometimes it looks like a normal number. Sometimes it looks like this. As always, you must convert. So you'll just multiply by 100. So when you multiply by 100, looks again like this. Now I have to explain this part. Yeah, well, the way I set this calculator to look like this, but on your calculator, it'll look like 0.03888 and so on. And I will try to explain this. Hopefully it does not confuse you guys further, but yeah, the answer that we spoke about initially is the one that you're supposed to get. But anyways, I'll explain this, but let me repeat the process again. So you'll open a bracket, and then you'll say 14%, then you'll say minus 13.6%, then you close the bracket to the power 2, and then times 50%, which is a probability. Okay, so the answer that you get, you don't do anything, you just multiply by 100, you convert it to a percentage. So this is the number we have, right? We have 8 times 10 to the power negative 4. I'll just explain shortly how do you work with this number. So this is one of those examples I was referring to when I said that you can explain how to do something, but somehow the numbers that you get on your calculator, you can't work around them. So it's one of the importance of having someone to guide you, because when you get stuck with something like this, they will quickly just explain, right? There's a hand raised, you can ask.
Hi, Mr. Ledwell. Mine is not to ask, it's just to assist. I use a Sharp financial calculator. So instead of putting the percentages as they are, I put 0. Let's say, for example, 14%, I'll put 0.14
Yes.
minus 0.136.
Yes. Okay, wait. Yeah, before you complete your sentence, did you get your final answer?
Yes, I did.
How much was it?
You want it with 3 decimals or two decimals?
Just give me your The one that you're confident with.
Zero.
Is what?
0.
0%, right?
0,00.
Okay, so
Yeah, or
initially it was what before you
0,0.
rounded off?
It was okay. It was 0,0000. And then it goes on because I only have three digits after the comma.
Okay, well, your answer is correct, but let me just explain to others. So yeah, I will just come back to you. Thanks. Okay, so here's what happens, right? This will need a special page on its own. So remember, we got an answer that looks like this: 8 times 10 to the power negative 4, right? Which is a percentage, by the way. So please, guys, like I said, just be patient with yourself. If this is the first time, you're here to learn. You're not here to just be the master on the first day. So this is the number that we have, which is a percentage. Okay, and this number here, we can write it in a way which makes sense. What is that way? If you look here, you have negative 4. All right, this part, you have negative 4. Then if you look here, you have this 8. Okay. Someone's all right. Yes, 2,000,008. That is perfect. Before you round off. All right. So if you look at this number that we have here, this 4, they represent the amount of zeros. So you'll have 4 zeros. You'll have 1, 2, 3, 4, and then you'll have 8. But every time you must always have a comma here. Every single time. It does not matter if it's what. You must have a 0 then a comma. You cannot have 0 0 comma. You must have a 0 and a comma, right? So like I said, that negative 4, it represents the number of zeros, which is 4, and then you have that 8 there, so you'll have a percent. Okay, if you round this off, it will become 0,00%, like Itumeleng said, that she got a 0%. So this is one of those calculation that I said needs confidence. It didn't even take us a semester. I said we will learn throughout the semester, but look, we just came across it right now. So sometimes a student will get an answer that is 0, and then because of no confidence, they will feel like no, maybe I'm doing something wrong. Okay, so let me just explain again what I said here. So the calculator gave us, after we converted to a percentage, gave us 8 times 10 to the power negative 4. And then we know that it's a percentage, right? So we can just write it here. So I said to you, how do you write this as a normal number? First, you look at the exponent, the negative number, right? So since it is 4, you will have 4 zeros like this. And then what is this number here? It's 8. You just write 8 there, and then you put your comma. So you have 0,0008%. If you round this off, it will become 0,00%. So let's just imagine this number was 7 times 10 to the power negative 3. So that exponent, which is negative 3, it tells us that we will have 3 zeros. We will have 0, 0, 0. And then finally we look at this, we'll have 7. Then you'll just put your comma there. So basically you have 0,007, right, percent. So when you round it off, I think it will become 0,01%. So that is the idea behind that calculation. Do we have any question regarding this? I will expect, but like I said, guys, just be patient with yourself. Okay, so perfect. So the solution that we got here was 0,0008%, which when you round it off gives us 0,00%. Right? These kinds of answers, they exist in financial management. Removing the incorrect thing. Okay, so as long as you prepared, you practiced, when they come up, you will not doubt your answers. You will not doubt yourself. You will know that this is very possible, and I'm sticking with my answer. So let's do the next one, which might be the last one. Our return is 18%. Our expected return is 13.6%. Remember, it's the one that we have calculated previously. Here it is in yellow, 13.6%. And then we will multiply with P, which is our probability, 20%. All right. I will also show this one on a calculator, by the way. Hopefully this one is a bit easy, right? So I'll show this one. Where did my calculator go? All right. Please let me know if you can see the calculator. Can you guys see now? Can you see the calculator?
Yes.
Okay. That's perfect. Alright, so remember we start off by opening a bracket, right? We'll say bracket, and then you'll have your return, which is 18%, and then you will minus with the expected, which is 13.6%, close bracket to the power 2, then times the probability, which is 20%. Okay, so you get that answer, you don't touch it, you just convert it into a percentage immediately by multiplying by 100. So when you get that answer, this is what you will have. So you see this one is different from the previous one. This one is understandable, I think, for most of us. We have 0,03872. When we round this off, we will get 0,04%. Let me just repeat again. We will have 18% over there minus 13.6% over there to the power 2 times 20%. So remember, you just convert it to a percentage immediately. You don't do anything, and that's when you can press the SD button to find what the decimal is. Then you'll have 0,03872, which when we round it off is 0,04%. Is it clear, guys? Hopefully yes. Someone's hand is up, you can ask. I think it was Sandra. Yes, you can ask if you still have a question.
No, I think I raised it in error. Sorry.
All right, no
I'm
problem.
clear.
Perfect.
Thanks.
Okay, so back to our answer sheet. Remember, after rounding off, we will get a 0,04%. Okay, it's showing. I will have 0,04%. So as soon as you're done with all the calculation, you just add all the three values, right? You'll add all these three values. So you'll have 0.04% plus 0.00% plus 0.04%. This will give us 0.08%. So I did calculate this, even though I could see it in my head what it was. But when it comes to finance, guys, always be humble and just calculate the easiest. Even if they say 2 plus 1, pick up your calculator. 2 plus 1, you get the 3, you write it down. Because if you get into a habit of doing things in your head, you'll do even the things you shouldn't do with your head, and then you'll just, we don't want to go there. So we have 0.08%. Then the last step of calculating our standard deviation, we'll say the square root of 0.08%. Okay, square root of 0.08%, and that is going to be equal to 0.02828 It continues, right? That number, as always, converted to a percentage, so you'll just multiply by 100. The percentage is going to be 2.83%. Let me just show it on a calculator as well, but this one I believe it's a bit easier. It's not that challenging, but you can see the trend so far that most of these things we have to convert into a percentage because we're dealing with percentages, right? You have to convert them into a percentage. All right, what did I say I was going to do? Oh, show it on a calculator. Okay, so remember I was going to show the square root process, right? So I'll just have your square root there. So you'll see that all the things that I wrote down, they also appear on the calculator, right? Which is assuring because it tells you that you're doing the right thing on the calculator, not what you're writing, obviously. So you'll have 0.08%, just like that. That's what we wrote. And then you'll have equal, and then you don't do anything to this. You just convert into a percentage immediately, right? And then there's when you can press this SD button. So you'll have 2.828 When you run that off, it's going to be 2.83%. All right. So is that clear? If it is clear, guys, you don't have to say anything. Now I'll just know by silence that you're all on the same page. But if you do have a question, you can ask. Now we will be heading back to our answer sheet. So we have answered the standard deviation and the expected return of website A, and then the results that we got. Let me write them down. So website A, if we invest in website A, the return on our investment will be 13.6%, and then the risk that will come with that investment will be 83%. But remember, we have to compare, right? We also have to do website B, but we don't do we won't do website B because the purpose of this session was to teach how to do this, right? So I'll just give you guys the results, and then we will compare, and then we will see how do we compare and how do we reason. So the expected return for website B, right, is 12%. So let me just also write the result over here. So the process is the same. You can actually do this on your own to practice to see if you will also get 12%, or you will get 11.72. Obviously, after rounding off, you'll get 12%. But let me just write the one that is not rounded off, just so we avoid confusion. 11.7%, like that. So sorry if I did cause some confusion. And then the standard deviation is going to be 2%, right? Which is the risk. Standard deviation, remember, is the risk. Okay, so this is for website B. Website B, this is for website A. Okay, so a question then comes and say, which one would you recommend? So here you're just going to use simple logic, but even though you use simple logic, you could find that the question says 7 marks, and you start to wonder, where do these 7 marks come from? Because I cannot just say I'm going to choose website A and then they give me 7 marks. So you get those 7 marks by explaining. Right, you explain return, and you also explain the risk or standard deviation. Right, I'm lazy to write the standard deviation, that's why I keep saying risk. Right, you have to explain that, you'll get marks from that. And then by quoting numbers, what do I mean by this? You have to explain as if you're explaining to a child, right? So you will say that website A's return is 13.6, and then website B's return is 11.7%. Then you conclude to say that in this case, in terms of return, website A is the better one. All right, that's quoting the numbers. So you see, you explain as if you explain to a child, because I mean the calculation can show which one is how much is the other one, but you still say it like someone does not see that. So you will get marks by doing that. Then you move to standard deviation, and you will say website A standard deviation is 2.83%, and then website B standard deviation is 2%. In this case, in terms of the risk or standard deviation, website B is better. Remember, because risk is a bad thing, right? Risk is bad. You have to take the lowest one. All right. Even right now, if you want to buy, is there anyone looking to ask a question before we go any further?
Yes, Mr. Dwala. Okay, I just wanted to ask something. With the second one, standard deviation, can your answer just be the company said that they are risk averse, therefore we prefer website B,
Well,
which is lower in risk?
but you're forgetting something. Mr. Ludaba also requires 12%. So is the website B satisfying his requirements with the 11.7%?
Okay, I understand now. Thank you.
Yes, perfect. But I like your reasoning because it shows that there is understanding there, because the company is risk averse. Obviously, they will look to take the less risky one. But the company also did say that, well, we're okay with the risk as long as it's not more than 6%. So all of them are not more than 6%. So meaning all of them, in terms of risk, they qualify, but in terms of return, they do not qualify. But yeah, really good question. So as I was explaining, you will say that the website A's risk is 2.83%, the website B's risk is 2%. In this case, website B is the better one because they have low risk of 2%. So you can see that the way I'm explaining, it's like I'm talking to a child, right? But this is how you get those marks, by being clear as much as you can. Right? You'll explain. This is like writing a report, because remember, when you're in finance, when you do these things, they might go to a different department whereby these people don't even know some of these things, right? So when you write this report, it must be as clear as possible so that the next person that receives it will not be calling you and say, hey, Dumeling, or hey, Sarah, or hey, what is this? What do these numbers mean? And then now you have to explain. Right, so your report must be as clear as possible. That's why we reason like this. Every time they say substitute your answer, What they mean is write a report. They want to see if you can write a clear report talking about these things. Okay, so now as soon as you're done quoting the numbers, right, you would have explained return, risk, quote the numbers, you'll then conclude, right, to say that we recommend website A, right? Then you'll say that because it meets the minimum requirements of 12% return. Remember, it's more than that, right? And it also meets the requirements of less than 6% risk. Okay, and that's how you're going to answer. So please, I'm going to share this with you maybe tomorrow. You can just use it to practice by calculating for website B. And then when the lessons will start, I'll also share the timetable, but we'll start, if not next week, then definitely Monday, because we have to start as soon as possible. So the way the lessons will go, guys, they will repeat. Right, they will repeat, I think 2 times or 3 times, but definitely 2 times, right? So because we know that some people will join midway and some people will join last day, so they will definitely repeat. But my advice to you is just get this out of the way as soon as possible, right? And just watch the videos in your own spare time, because guys, this module is not easy. If I said it's easy at the beginning and now I'm contradicting myself, by what I mean is that there's lots of work, right? I'm not saying it's difficult, I'm not saying it's not easy, like it's difficult, just that there's too much to do and then you can easily forget things. That's what I mean. So I'm not trying to discourage you guys. So any questions regarding this or anything, you can ask. Okay, if there's no question, guys, then this is a good night from me. Thank you very much for joining. Bye.
Okay, thank
Thank
you.
you. Bye bye.
Thank you. Bye.
Thank you so much. Bye.